Silver has only ever had one true enemy. Not the trading desks, not the short sellers, not the loud voices on the financial channels who tell you it is a barbarous relic. All of those are noise. The one thing that has ever truly broken silver, the one force that could put this metal to sleep for years at a time, is a bond that pays you a real return. A safe piece of paper that hands you more purchasing power at the end of the year than it took from you at the start. When that paper exists, gold and silver struggle. When it fades, they wake up. And right now, quietly, that enemy is fading. If you are holding silver right now, or if you have been thinking about it and hesitating, I want you to hear this clearly. The turning point everyone keeps waiting for, the one they say is still coming, has in an important sense already arrived. Not in a headline, not in a single day's price. It arrived in the slow retreat of the only thing that ever stood in silver's way. In the next 20 minutes, I am going to show you exactly what that enemy is, why it once crushed this metal for the better part of 2 decades, and why the ground underneath it has shifted in a way most people have not noticed yet. Let me give you the anchor of this whole story right up front, because it is the key that unlocks everything else. Go back to the end of the 1970s. Gold and silver had run wild, and then a man named Paul Volcker took the reins of the Federal Reserve and did something brutal and deliberate. He drove interest rates up into the high teens. He made cash king. He made it so that simply holding a government bond paid you a fat, real, inflation-beating return year after year. And in that world, why would anyone hold a metal that pays no interest? They would not. So they sold. Gold, which had been the trade of the decade, went quiet for the better part of 20 years. That was not magic. That was the one true enemy, wielded at full strength. I want you to sit with that mechanism, because it is the whole game. Gold and silver do not pay a dividend. They do not pay interest. They just sit there and hold value. So the question every dollar in the world is always asking is simple. What am I giving up to hold this metal instead of a safe piece of paper? When that safe paper pays a rich real return, the metal looks expensive to own. When that safe paper pays you nothing, or worse, quietly loses to inflation, then the metal costs you nothing to hold, and it starts to shine. Real yields. That is the enemy. Everything else is a sideshow. Now here is why this matters so much right now, and why I called this a turning point that has already arrived. For most of the last 40 years, there was an old, reliable relationship. When real yields went up, gold went down. Higher real return on paper, lower price for the metal. You could almost set your watch by it. The big banks and the trading desks built their models around it. And then, in the last couple of years, that relationship broke. Real yield stayed high, stubbornly high, and gold did not fall the way the old rule said it should. It climbed. It set records. The one iron law that governed this metal for a generation simply stopped working. And the people whose entire worldview depends on that old law do not want to talk about why. Let me tell you why it broke, because this is the part they gloss over. The old rule assumed that the marginal buyer of gold was a Western investor deciding between a bond and a bar. But that buyer is no longer the one setting the price. The buyer setting the price now is the central banks themselves, buying physical metal by the vault load, and they are not doing it because they ran a yield calculation. They are doing it out of caution, out of a need to hold something that no other country can freeze or cancel. When the marginal buyer stops caring about yield, the old yield rule dies. And that is exactly what has happened. And there is a specific reason those cautious buyers change their behavior, one that ties directly into why the metal's enemy is losing its grip. A few years ago, one major power had its foreign currency reserves frozen from the outside. In an instant, money that a country thought it owned became money it could not touch. Now, every central bank on earth had to ask itself a quiet, unsettling question. What do we actually own that no one else can freeze? And there is really only one honest answer. Gold held in your own vault cannot be sanctioned, cannot be canceled, cannot be frozen by another country's decision. It answers to no one. That single realization lit a fire under official buying that has not gone out, and it has nothing whatsoever to do with the level of interest rates. The old enemy has been sidelined by a buyer who does not even glance at it. And this is where I want to stop and talk to you directly, because there is something here you can actually do, and almost nobody tells retirees about it. The central banks have been buying gold at a record pace, more than 1,000 tons a year for 3 straight years, roughly double what they bought in the decade before. Gold recently passed the euro to become the second largest reserve asset in the world, behind only the US dollar. The most cautious institutions on the planet are quietly moving into metal. And here's the part they never mention on the evening news. There is a perfectly legal, quiet way for an ordinary American to do the very same thing inside the retirement account you already have. You can move a portion of a 401k or an IRA into physical gold and silver, held in a self-directed precious metals IRA, without triggering taxes and without triggering penalties. This is not some loophole for insiders and hedge funds. If you have $100,000 or more in any retirement account, this is available to you, the same protection the central banks are reaching for. If you are watching this on your television, you can scan the QR code on your screen right now. If you are on your phone or your computer, just go to jeffreedguide.com and we will send you the free information on exactly how it works. Now, let me come back to silver specifically, because silver's story is even sharper than gold's. Silver has touched a ceiling near $50 only twice in modern history. Once at the very top in January of 1980, and once again in the spring of 2011. Think about that. Those two peaks are roughly 31 years apart, and both stopped at nearly the same wall, which means the base underneath this metal, the long floor it has been building, is something like 45 years wide. In all the markets I have watched over the years, I have rarely seen a foundation that long and that patient. And a base that wide does not exist to trap you. It exists to launch from. Here is a fact that should stop you in your tracks. That 1980 high of around $50 was $50 in the money of that day. Adjust it for everything that has happened to the dollar since, for all the inflation of the decades in between, and silver's real inflation-adjusted high is far, far above 50. It is well into the low three figures in today's money, and silver has never once reclaimed that real high. Not in 1980 prices, in today's prices. So when someone tells you silver near its old ceiling is expensive, understand what they are really saying. They are measuring a 45-year-old high in shrunken dollars and calling it a top. In real terms, this metal is nowhere near where it has already been. Now, the financial media loves to point at silver's wild swings and use them to scare you off. And I will be honest with you, silver does swing hard, but you have to understand where those swings come from, because they are almost never about silver itself. Back in 2011, the exchanges raised the margin requirements on silver several times in quick succession, and the price fell around 30% in a matter of days. Nothing fundamental about silver changed in those days. Not 1 ounce came out of the ground differently. What changed were the rules on the paper. The people who write the rules on the paper can move the price of the paper, and they can do it fast. That is the shakeout. And most people sell right into it at exactly the wrong moment. That is the difference I need you to hold on to between the metal and the paper. When you own a bar of silver or a metal held for you in a vault with your name on it, the rules cannot be rewritten out from under you. We have watched more than once what happens when the paper claims and the real metal come into conflict. In one dramatic case a few years ago, an exchange simply canceled completed trades when the paper side was losing to the metal. Canceled them, trades that had already happened. That tells you everything about which one is real. The paper is a promise, and promises can be broken by the people who wrote them. The metal in your hand answers to no committee. And silver has a second engine that gold does not, one that makes its supply story quietly tighter every single year. Gold is hoarded. Almost every ounce of gold ever mined is still sitting in a vault or on someone's finger somewhere, and it can come back to the market if the price is right. Silver is different. Silver gets used up. It goes into solar panels, into electronics, into 1,000 tiny industrial uses, spread out in amounts so small it is not worth anyone's time to recover. Gold is hoarded, and silver is burned. And the silver market has now run a supply deficit for several straight years, using more than it produces. That is a slow structural tightening happening underneath all the noise, and it does not reverse on a headline. Let me put the two metals side by side for a moment, because their ratio tells a story. During the panic of 2020, silver crashed toward $12 in a matter of weeks, and the gold to silver ratio spiked toward 125. It took an enormous amount of silver to buy a single ounce of gold. That is what fear looks like. And then over the following months, silver ran back toward 30, and the ratio compressed hard because silver outran gold on the way up. That is the pattern. Silver falls harder in the fear, and then it climbs harder in the recovery. It is the more emotional of the two metals, and if you understand that in advance, its volatility stops being a threat and starts being an opportunity. And here is the deeper reason I do not believe the old enemy can simply march back the way it did after the 1970s. When Volcker raised rates into the high teens, the government could survive it. The debt was small enough that punishing interest rates did not threaten to bankrupt the country that issued the bonds. That is no longer the world we live in. The pile of government debt today, all around the world, is so enormous that pinning real yields back up to the punishing levels that once broke gold would risk breaking the borrowers themselves. There is even a name for this trap. When a government owes so much that its central bank can no longer raise rates hard without triggering a crisis, we call it fiscal dominance, and it is not a new idea. In the years before the Treasury and the Fed reached their historic accord in the early 1950s, the Fed spent about a decade holding down government bond yields on purpose. The tool that once destroyed gold, a rich, real return on safe paper, is precisely the tool a heavily indebted world can least afford to use. That is why I say the enemy is not merely resting, it is boxed in. Now, think about what happens to both of these metals when the one true enemy, real yields, keeps fading. We just watched, not long ago, how sensitive this market is to even a hint of easier money. Years back, the Fed merely suggested it might slow its buying. Just a hint, not even an action, and gold fell sharply that year on the fear of it. That is how powerful the yield story is in both directions. If a hint of tighter money could shake the metal, then the slow structural fade of the metal's only enemy is a tailwind that builds for years, not days. The desks that made their careers on the old inverse rule are still fighting the last war. They keep waiting for high real yields to break gold the way they always did, and gold just keeps climbing anyway. History is full of proof that the worst-looking moments are the ones that matter most. The very thing that put gold to sleep after Volcker, a rich real return on safe paper, is the thing now quietly fading. And each time in the past that enemy weakened, the metal everyone had left for dead came roaring back to life. In 2015, after a long and demoralizing decline that had everyone declaring the metal dead, gold quietly put in a bottom and began the long climb that eventually carried it to new records. The lesson repeats over and over. The metal gets sold in the moment of maximum fear by people who have simply lost their nerve or been shaken loose in a scramble for cash, and that is almost always exactly the wrong moment to join them. I want to be straight with you about the risks, because anyone who is not is selling you something. I cannot promise you a price, and I will not promise you a date. Silver is volatile, more volatile than gold, and there will be sharp drops along the way that feel like the whole story was wrong. There will be days the media crows that the metal is dead. This is a case built on history and on structure. It is not a guarantee, and it is not personal financial advice for your specific situation. What I can tell you is how thoughtful people handle it. You own the real metal, not a paper claim on it. You size your position so that a sharp drop can never force you to sell at the bottom. And when the shakeout comes, and it will come, you do not sell into it. The whole point of owning the metal is that you can hold it through the very storm that scares everyone else out. And now I want to say the hardest and most important thing in this whole video. If any of this is landing with you, understand what that means. It means you are early. The turning point has already arrived in the mechanics, in the fading of real yields, in the broken correlation, in the central banks quietly loading up. But it has not yet arrived in the minds of the crowd. The smart money, the most cautious institutions on earth, they already see it. They are already moving. The mainstream, the financial channels, the neighbor at the barbecue, they have not caught on yet. And here is the thing about these turns. By the time it is obvious to everyone, by the time silver is the story on every front page, the easy part of the move is already behind us. Nobody rings a bell at the turning point. Nobody sends you an invitation in the mail. The invitation is the quiet unease you feel right now, watching this, while it is still early. So let me bring this all the way back to where we started. Has silver's turning point already arrived? In the way that actually matters? Yes. The one true enemy that ever broke this metal, a bond that pays a real return, the very weapon that put gold to sleep for 2 decades after Volcker, that enemy is fading. The old rule that tied the metal to real yields has broken. The most cautious buyers in the world are moving. The base under silver is 45 years wide. The supply gets tighter every year. Everything is in place. What is missing is the crowd, and the crowd always comes last. If you have watched this far, you are exactly the kind of person this next part is for. I hold a free one-on-one educational web conference for folks who are serious about protecting their retirement, and it is for viewers with $100,000 or more in a 401k or an IRA. It is not a sales pitch, and it is not a webinar with 1,000 strangers. It is a real conversation about whether moving a portion of your savings into physical gold and silver makes sense for your situation. And here is the honest reason I would not wait. The best decisions about protection are made calmly, while the water is still, before the crowd arrives and the emotion takes over. Right now, while this is still early and still quiet, is exactly when a clear-headed decision is easiest to make. When you reach out, just mention that you watched this full video. If you're on your television, scan the QR code on your screen. If you're on your phone or your computer, go to jeffradeguy.com. Take the calm moment while you still have it. Thank you for watching, and I will see you in the next one.